A brutal housing collapse is coming to California in 2025, and these 15 cities are staring down the steepest crash in years. Sky-high prices and fading demand are forming one of the most dramatic storms ever, which is why today we expose in what cities the market is about to implode, and why 2025 could be a disaster for Californian homeowners. With a population of over 160,000, Salinas is often called the salad bowl of the world, thanks to its massive agricultural industry. But lately, what's growing fastest isn't lettuce, it's housing costs. And that's becoming a problem. The median home price in Salinas is currently just under $850,000. That's higher than Sacramento, Las Vegas, and even parts of San Diego. Meanwhile, the median household income sits around $75,000, creating a massive affordability gap. According to the Orange County Register and Atom Data Solutions, Salinas is one of the top 5 most over-leveraged housing markets in the state, meaning people are stretching themselves thin just to afford a home. In fact, a 2024 Zillow report noted that you'd need to earn nearly $300,000 a year to comfortably buy a median-priced home here. So, who's buying? The answer? Not many. As interest rates climbed in late 2023 and early 2024, demand began falling off a cliff. New listings have increased by over 22% year over year, but sales volume is down. That's a clear imbalance between supply and demand. And it's not just numbers. Locals are feeling it. Many lifelong residents are being priced out of their own city, and younger families are heading north to places like Modesto, or even out of state entirely. Investors who bought during the pandemic are beginning to offload properties, fearing that prices may already have peaked. Bottom line, with stagnant wages, climbing inventory, and affordability completely out of sync, Salinas looks poised for a serious housing correction in 2025. Now let's talk about Los Angeles, the city of stars, freeways, and now one of the most inflated housing markets in America. The average home in LA costs about $925,000, but the median household income hovers around $75,000. That's a mortgage-to-income ratio of nearly 12 to 1, which is wildly unsustainable by historical standards. In fact, a Moody's Analytics study labeled Los Angeles as one of the most overvalued metro markets in the country, even after adjusting for its high demand and land constraints. But what makes LA particularly vulnerable isn't just price, it's insurance. Following back-to-back wildfires, earthquakes, and billion-dollar storm seasons, both State Farm and Allstate pulled out of writing new home insurance policies in California, citing risk and cost. That means new buyers in LA often face skyrocketing insurance premiums or worse, no coverage options at all. Add in rising crime rates in some areas, declining public services, and a growing number of vacant luxury condos, and it's no wonder people are slowly trickling out. Between 2020 and 2024, LA County lost over 300,000 residents, according to the U.S. Census. Investors have taken note. Several major investment firms, including Blackstone and Invitation Homes, have begun quietly selling off properties across Southern California, especially in mid-tier neighborhoods like Van Nuys, West Adams, and Highland Park. What's more, LA saw a building boom from 2020 to 2022, particularly in downtown and South Central. Those projects are now hitting the market in 2025, but demand hasn't kept up, leaving developers sitting on overpriced units they can't fill. Los Angeles might not collapse overnight, but all signs point to a softening market at best, and at worst, a long overdue correction that finally brings prices closer to reality. But we have to talk about Milpitas next. Milpitas is a small but densely populated city just north of San Jose, right in the heart of Silicon Valley. With around 80,000 residents and a median home price over $1.5 million, Milpitas is officially 99.7% overvalued, according to a 2024 Fitch Ratings housing report. That's not a typo. nearly double what historical trends suggest it should cost. And what's even more concerning, the local economy is heavily tied to the fate of big tech, especially companies like Cisco, Intel, and Nvidia. Here's the problem. After massive growth in the pandemic years, tech companies have pulled back. Between 2022 and 2024, Silicon Valley saw over 200,000 layoffs, many of which affected Milpitas residents. With remote work now normalized, fewer employees feel the need to stay in pricey cities like this. Rental vacancies are up. For-sale inventory has jumped over 30% since 2023, and average days on market is increasing. One local real estate agent recently described the Milpitas market as uncomfortably quiet. Milpitas also faces the risk of being overshadowed. Nearby cities like San Jose and Fremont are larger, better connected, and offer more diverse amenities. As buyers look for value in the Bay Area, Milpitas may be the first to lose its inflated edge. Expect price cuts, investor pullback, and a reevaluation of just how much tech proximity is worth in the remote work era. Next up is San Ramon. This city might not be a household name, but it's one of the wealthiest suburbs in California. And that's part of the problem. Located in Contra Costa County, east of San Francisco, San Ramon is home to about 85,000 residents. It's a master-planned community with high-performing schools, clean streets, and corporate HQs like Chevron and AT&T's West Coast offices. But in 2025, the San Ramon housing market is looking dangerously top-heavy. Median home prices are over $1.6 million, yet buyer demand has shriveled. According to Redfin, price reductions have doubled year over year, and homes are sitting unsold for longer than they have in nearly a decade. Part of the issue? The tech downturn. San Ramon's proximity to the Tri-Valley and South Bay job markets means it rode the wave of the remote work boom, but that wave has crashed. People who once moved here to escape the Bay Area's chaos are now questioning why they're paying premium prices to live in a quiet suburb they barely leave. Another major factor, overbuilding. Between 2020 and 2023, San Ramon approved dozens of high-density housing projects. Many of those units are hitting the market now, and with fewer buyers and tighter lending standards, the supply-demand balance is off. Unlike flashier markets, San Ramon tends to lag behind in price corrections, but when it drops hard. After the 2008 crash, some home values here fell by 25 to 30%. If history repeats itself, we could be looking at another painful adjustment in 2025. Now on to Newport Beach, one of the most desirable, picturesque, and overvalued cities on the Southern California coast. With a population just over 85,000, Newport has long been a playground for the wealthy. Think yachts, luxury shopping, and waterfront homes selling for $3 to $10 million. But in 2025, the market here is showing serious cracks. The high-end sector is especially fragile right now. According to Douglas Elliman's Q1 market report, luxury home sales in Orange County fell 42% year over year, and Newport Beach was hit hardest. That's because even affluent buyers are starting to pull back. Interest rates are higher, capital markets are tighter, and wealthy homeowners are looking to offload second homes they no longer use or can no longer insure. And that's another major problem: insurance. Newport Beach is highly exposed to coastal erosion, rising sea levels, and wildfire threats from nearby hills. In 2024, Farmers Insurance stopped writing new policies in several Southern California zip codes, including Newport. That's left many luxury homeowners scrambling to find expensive private insurers, or worse, going uninsured altogether. Meanwhile, the city's strict zoning laws and lack of affordable housing make it hard to attract new buyers beyond the ultra-rich. Inventory is building, but qualified demand isn't. And even in paradise, if the math doesn't work, the prices will fall. Experts say if interest rates stay high, The luxury sector in cities like Newport Beach could see a correction of 15 to 20% this year, particularly for homes over $3 million, which, in Newport, is practically the entry point. Irvine is a California city with a shining reputation and a price tag to match, but in 2025, it may be facing a reckoning. Located in the heart of Orange County, Irvine is known for its master-planned communities, top-rated schools, and massive presence of tech and biotech companies. It's home to over 310,000 residents, and median home prices are hovering around $1.4 million. That's up nearly 50% since 2019. But the momentum is slowing. In fact, it's reversing. According to CoreLogic, home price growth in Irvine has flattened completely since late 2023. The number of active listings is up 31% year over year, and average time on market has doubled. The reason? High prices, fewer tech jobs, and a massive surge in new construction that's flooding the market with inventory. Over the last 5 years, Irvine approved thousands of new condo and townhome units across the Spectrum, Great Park, and Portola Springs neighborhoods. Many of those properties are finishing construction now, and builders are having trouble finding buyers. Combine that with the tech sector's downturn, Broadcom, Amazon, and Google all have offices here, and the city's reliance on highly paid white-collar workers starts to look risky. Remote work has also given many residents the flexibility to move to cheaper cities while keeping their jobs. One more red flag: foreign investment. Irvine has long been a hotspot for international buyers, particularly from China and South Korea. But 2024 saw a 30% drop in foreign purchases, thanks to new capital control laws abroad and currency pressures. If demand doesn't bounce back soon, Irvine could be looking at a 10 to 15% drop in home values, especially in new build developments where sellers are already offering incentives and price cuts. Next up is San Diego, a city that, while beloved for its beaches and lifestyle, may finally be hitting its housing price ceiling. With a metro population of over 3 million, San Diego is the second largest city in California by land area and one of the fastest growing during the pandemic. But that growth came at a cost. Home prices shot up nearly 70% between 2020 and 2023, with the median now sitting around $910,000. Here's where it gets tricky. Unlike other major metros, San Diego didn't build enough housing to meet that demand surge. But now, in 2025, demand has sharply cooled, and homeowners are sitting on properties they can't sell at peak prices. Redfin reports show that the number of price reductions in San Diego increased 40% over the past year, and new listings are staying active for longer periods. The city also faces growing pressure from the insurance sector, especially in hillside areas like La Mesa and El Cajon, where wildfire risk is high. This has added extra monthly costs that many buyers simply aren't willing to take on. Worse yet, San Diego's job market is shifting. Biotech, defense, and higher education are still anchors, but many young professionals are heading to cheaper metros like Denver and Salt Lake City. The city also saw a net loss of residents in 2023 for the first time in over a decade, suggesting the affordability crisis is pushing people out. Even local agents are beginning to acknowledge it. Unless prices drop significantly, the market will remain frozen, leading to a natural correction by year's end. Chino may not be the first city that comes to mind when you think of California real estate, but it's one of the clearest examples of a pandemic boomtown that's now heading for a bust. Located in San Bernardino County and home to over 90,000 residents, Chino saw an influx of buyers in 2021 and 2022. Many of whom were priced out of LA or Orange County. Developers capitalized on this, building sprawling new home communities with sleek branding and sky-high prices, often in the $800,000 to $1 million range. But in 2025, the cracks are showing. According to Realtor.com, Chino's housing inventory is up 47% compared to last year, and the average home is sitting on the market for nearly 60 days, a sharp change from the bidding wars of just 2 years ago. Buyers who purchased at the peak are now watching their home values stagnate, or worse, fall below their original purchase price. There's also the issue of distance. Chino is over 40 miles from downtown Los Angeles, and with remote work waning, more people are reconsidering long commutes. That puts pressure on demand. The final nail in the coffin? A wave of adjustable rate mortgages that are now resetting in 2025. Many new homeowners in Chino took on risky loans to buy in during the boom. With rates rising and home values plateauing, defaults and distressed sales are expected to increase this year. It's not dramatic yet, but all signs point to a housing slowdown that could tip into a crash if economic conditions worsen. Now on to Bakersfield, which has long been known as one of California's more affordable large cities. But even here, the housing market may be heading towards serious trouble. With a population of over 400,000, Bakersfield saw a surge of new residents during the pandemic years, largely because it offered larger homes and lower prices compared to Los Angeles. Between 2020 and 2022, the median home price jumped from $270,000 to nearly $400,000, driven by demand from first-time buyers and investors. But now things are shifting fast. In 2024, the median home price in Bakersfield dropped 6%, the first annual decline in over a decade. And that's just the beginning. Inventory is rising rapidly, especially in new-build neighborhoods on the city's outskirts. According to Zillow, more than 20% of listings have seen price reductions in the past 3 months alone. One big issue is the job market. Bakersfield's economy is heavily dependent on agriculture and oil, two sectors that are vulnerable to automation, regulation, and environmental factors. When Chevron laid off 800 local workers in late 2023, it sent a ripple through the economy. And with the state tightening restrictions on oil drilling, long-term employment stability in the region is uncertain. Add in rising insurance costs due to Central Valley wildfire exposure, and the math becomes even shakier. Experts warn that if mortgage rates stay high and job growth continues to stagnate, Bakersfield could face a housing correction of 10 to 15% or more by early 2026. Modesto might not be flashy, but it became one of California's pandemic-era boomtowns, and that's exactly why it's now at risk of a bust. With over 218,000 residents, Modesto is a Central Valley city known for agriculture, commuter culture, and a relatively low cost of living. But between 2020 and 2022, it saw an unprecedented 40% spike in home prices as Bay Area workers fled to cheaper pastures. Investors followed, flipping homes and pushing values even higher. Fast forward to 2025, and that momentum has reversed. Listings are piling up, prices are falling. The median home price is down from its 2022 high of $465,000 to around $420,000. And that's with sellers still trying to hold the line. Why? For starters, a lot of Modesto's recent growth was speculative. Many buyers were relying on rental income or short-term appreciation, but rents are now flatlining, vacancies are up, and demand is slipping away. In 2024 alone, Modesto saw a net outmigration of 5,000 residents, many of whom moved to even cheaper states like Texas or Arizona. The other problem? Employment. Modesto's economy remains largely centered on logistics, healthcare, and agriculture, industries with modest wages. So when home prices soared, they quickly detached from local incomes. And now that interest rates are high and lending is tight, local buyers simply can't afford what's on the market. Unless prices come down sharply, experts predict a painful correction is inevitable, one that could erase much of the equity gained during the pandemic surge. Fresno is the largest city in California's Central Valley, with over 540,000 residents, and it may be facing one of the most serious housing corrections in the region. During the pandemic, Fresno experienced explosive growth. In 2021 alone, home prices rose over 20%, as Bay Area refugees rushed in seeking space and affordability. The median price peaked at nearly $430,000 in 2022, well above historical norms for the city. But now, that growth story is collapsing. Fresno's home prices declined by nearly 7% in 2024, with further drops expected in 2025. Inventory is building quickly, and many sellers are offering major concessions just to close deals. Real estate agents report that homes which used to get multiple offers are now sitting for months, even after price cuts. The economic base of Fresno isn't helping either. The city depends heavily on agriculture and public sector employment, both of which offer limited wage growth. Meanwhile, remote workers who once considered Fresno a bargain are now returning to their original metros or heading to out-of-state markets with better services. Another major concern: climate and insurance. Fresno has been hit hard by extreme heat and drought. In 2022, the city experienced 43 days over 100 degrees Fahrenheit, straining both infrastructure and resident patience. As a result, fire risk has surged, and several major insurance companies reduced coverage in the area, raising costs across the board. Experts warn that if rates remain high and investor demand continues to dry up, Fresno could see home prices fall another 10 to 15% in the next 12 months. And for many recent buyers, that means going underwater on their mortgages. Oceanside is a coastal gem in northern San Diego County with over 170,000 residents, but it's also quietly becoming one of California's most vulnerable housing markets in 2025. During the pandemic, Oceanside became a favorite for buyers priced out of LA and San Diego. Its mix of beach town charm and relative affordability made it attractive for remote workers and investors alike. Home prices surged nearly 60% from 2020 to 2022, with the median peaking around $880,000. But now the tide is turning, literally and figuratively. Oceanside's home values dropped 5% in 2024, and inventory is rising fast. A flood of new condos and townhomes hit the market over the past year, especially around Mission Avenue and South Oceanside. But buyer demand hasn't kept up, largely because many of those properties are priced out of reach for locals. And here's where it gets serious: climate vulnerability. Oceanside's beachfront neighborhoods are among the most at risk in California for sea level rise and storm surge. In fact, a 2024 NOAA report named Oceanside's coastline one of the top 5 erosion hotspots in the state, with up to 75 feet of shoreline loss expected by 2040. That's already affecting insurance availability, appraisal values, and long-term buyer interest. A recent San Diego Union Tribune investigation found that multiple properties near the Strand were quietly dropped from major insurers in late 2024 due to rising risk. Add in rising costs, slower job growth, and proximity to San Diego's softening market, and it's clear. Oceanside's market could see a correction of 10 to 20%, especially in luxury and coastal-facing properties. Riverside has always played second fiddle to Los Angeles, but during the pandemic, it got its time in the spotlight. Now that shine is fading fast. With over 317,000 residents, Riverside is the heart of the Inland Empire, known for its suburban sprawl, growing logistics sector, and family-friendly vibe. Between 2020 and 2022, home prices surged by more than 45%, peaking at around $610,000. The city became a magnet for buyers priced out of coastal metros. But in 2025, The same factors that caused the boom are setting up the bust. One problem? Overbuilding. Developers flooded the region with new subdivisions, especially near the 215 and 91 freeways. As of early 2025, housing inventory in Riverside is up 41% year over year, and more units are still coming online. That's a lot of homes chasing fewer buyers. Another factor is commute fatigue. Remote work made Riverside more attractive, but as hybrid work becomes the norm again, long commutes to LA and Orange County are once again a problem. In a recent Inland Empire mobility survey, 40% of Riverside commuters said they were considering a move closer to work. Also, the region's logistics-heavy economy, which boomed during the e-commerce wave, is showing cracks. Warehouse job growth has slowed, and a 2024 slowdown in cargo volume at the nearby ports has impacted employment. Experts now estimate that Riverside home values could fall another 8 to 12% by late 2025, especially in overbuilt neighborhoods on the outskirts where demand is softest. Oxnard might not get the same headlines as LA or San Francisco, but this coastal Ventura County city, just over 200,000 residents strong, is quietly heading toward a housing correction. Historically known for agriculture, strawberries, and quiet beaches, Oxnard became a sleeper hit during the pandemic. Home buyers priced out of Los Angeles, and Santa Barbara looked to Oxnard for coastal living at a discount. From 2020 to mid-2022, home prices in Oxnard rose by over 40%, with the median price peaking around $735,000. But as of 2025, the cracks are starting to show. For one, demand has dropped off sharply. A recent CoreLogic report showed Ventura County had one of the highest mortgage default upticks in Southern California, Oxnard leading the pack. Many of the people who bought at the peak are now seeing their home values stagnate or slide. Local income levels are also misaligned with home prices. According to the U.S. Census, the median household income in Oxnard is around $80,000, making the average mortgage extremely difficult to carry with today's interest rates. There's also an issue with insurance. Being a coastal city in a wildfire-prone zone, many insurers have pulled out or raised premiums dramatically. Some homeowners report insurance premiums rising over 70% in 2 years, further burdening monthly costs. And while Oxnard is beautiful, its job market hasn't kept pace. It lacks the diversified industries that neighboring cities have, relying heavily on agriculture, which doesn't translate into high-income homebuyers. Altogether, analysts predict a 10 to 15% drop in Oxnard home values through late 2025, especially in outer ring suburbs and neighborhoods with high investor ownership. California's capital city, Sacramento, could face one of the most painful housing corrections of them all. Sacramento surged during the pandemic, with homebuyers fleeing the Bay Area and tech workers going remote. The city became a hot destination seemingly overnight. From 2020 to 2022, prices rose more than 55%, pushing the median home price to nearly $575,000. But now the tide has turned. In 2024, home prices fell 7%, with more weakness expected through 2025. According to Redfin, Sacramento has one of the highest price reduction rates in the state, with over 30% of listings seeing cuts in the past quarter alone. So what's going on? First, the remote work boom is unwinding. Tech companies are calling people back to offices, at least part-time, which has made Sacramento less desirable for Bay Area workers. Commutes are back, and the perceived value gap between Sacramento and the Bay is shrinking. Second, the region's infrastructure is struggling to keep up. Rapid population growth put pressure on schools, roads, and public transit. Residents complain about overcrowding, rising crime, and increased wildfire smoke. In fact, Sacramento ranked in the top 10 worst U.S. cities for air quality in 2023, largely due to wildfire drift from nearby regions. And the biggest concern? Affordability collapse. Local wages simply don't support $500,000 home prices. Many buyers who jumped in during the peak are now underwater, and investor demand has cooled dramatically. Experts are warning that Sacramento could see a correction of 12 to 20%, particularly in newly built suburbs like Elk Grove and Natimas, where over-leveraged buyers are walking away from deals or listing at a loss. If you want to see more cities where housing prices will crash hard, click on the screen right now to watch another video.